Good evening and welcome to Econversations. I'm your host, Dan Sutter with the Johnson Center for Political Economy here at Troy University. The 2008 financial crisis and the ensuing recession stand as the signal events in recent American economic history. The interpretation of these events going forward is going to be very important for economic policy in the United States. Many people have suggested that deregulation of Wall Street in the 1990s set the stage for the torrent of greed and the ensuing financial crisis. To talk about the role of financial regulation, both in the 2008 crisis and throughout the last century of American economic history, I have with us tonight my colleague from the Johnson Center, Dr. Thomas Hogan. Thomas, welcome to the show.
Thank you.
Well, what happened in the 1990s in terms of changes in the regulatory structure, and did we actually see deregulation?
So it's funny that people talk about deregulation in the banking industry. I've heard it referred to as the banking industry was just completely deregulated, that it was like the Wild West with no rules at all. And I just find that a little bit bizarre because the banking industry is one of the most regulated industries in the United States. I mean, I think of it as being second to healthcare. Healthcare is probably the most regulated industry, but I think the banking industry is a close second there. And so it seems weird that people would characterize that as completely deregulated. And so when we look at banking regulations, certainly there was a little bit of deregulation during the 90s. And so I think what people do is they point to those specific things and say, oh, we had a little bit of deregulation. This ended all banking regulation. And that's clearly not true. So the one major piece of legislation that people tend to point to is the GrammL Bliley Act of 1999. And
so what did that act do specifically?
So the main thing that people generally point to in the GrammL Bliley Act is that there was before that time a separation of commercial banking and investment banking, and said that, well, these things have to be separate. In the United States, we have commercial banks, which are banks that accept deposits and make loans, and they can make other investments too, but they're primarily deposit holders. And we said that that has to be separate from investment banking and insurance and other types of financial functions.
Okay.
And so when people look at this, they say, well, that event is the thing that caused the financial crisis. There were a bunch of mergers and there were no longer any rules. And all these commercial banks started doing all this crazy investing and took all this risk, and that blew up in the financial crisis. That's the narrative.
Right.
Right? That's what people say, is they point to this one event and say, oh, well, that was it that deregulated the banking industry.
Now, you mentioned investment banking. There are also hedge funds that are part of Wall Street. Were they covered or affected by this deregulation?
So the hedge funds were not regulated at that time, and they were not part of the regular commercial banking and not under the Fed's purview. That's changed a little bit because of the DoddFrank Act. But when we look at that, hedge funds were not a major part of the financial crisis, right? And in fact, when we look at the separation between commercial and investment banking, people blame that. They say now, well, all these commercial banks, they got involved with investment banks, they took a lot of risk and it blew up. Except that that's not true. When we look at who was failing in the financial crisis, it was investment banks, it was Lehman Brothers, it was Bear Stearns, it was Merrill Lynch, but it wasn't the traditional commercial banks and bank holding companies that had merged together because of the changes of GrammL Bliley. And so it seems like although people are pointing to that as being one of the major causes of the crisis, it doesn't appear that in fact that really had very much influence at all.
Now, you mentioned how banking is so regulated, and so certainly the GrammL Bliley Act didn't get rid of all the regulations in total, and I think we have some numbers here on this point.
Yeah, in fact, it is a little bit funny when people talk about deregulation and they say, well, you know, GrammL Bliley, that changed things. You had a deep piece of deregulation right there. And I always think, well, when you take away one rule and then you add 10 more, that's not really deregulation, right? I mean, that's increasing the amount of regulation. And so that's basically what we saw throughout the 90s and 2000s in the banking industry. If we look at the diagram, we see that we did have, around the time of GrammLeach Bliley, we had a little bit of deregulation, and that one act was really responsible for most of it. But in the years before that, and in the years that followed that, we had increasing regulations in basically every year, right? And so it seems like over that term, the banking industry became much, much more regulated rather than becoming deregulated.
I think this is like an investment, an index of the degree of regulation from the Mercatus.
So we're looking, the pictures that we're looking at now are indexes of banking regulation created by the Mercatus Center, where they've counted up all the different regulations. And the first chart was banking overall, and now we have this separated into securities and commodities regulations versus funds and trusts and other investments. And we can see that both of these have a very large increase over the period from the late 90s until 2010.
And this is also another measure of this degree of regulation that didn't go away after 1999, right?
Yeah, exactly. So we see that when we're talking about things like GrammLeach Bliley that did eliminate some laws, we may have had a reduction in the number of regulations, but we may have actually had an increase in the amount of things that banks had to do or were not allowed to do. So basically, when we allowed commercial and investment banks to merge, we also put a lot more requirements on them in terms of what they were or were not allowed to do. And so the graph that we have here is taking the banking regulations and looking for the things that they must do, that's the line in red, or things that they may not do, that's the line in blue. And so you can see over this period, they basically had more things that they were required to do. They had a lot more reporting requirements. They had a lot more things that they had to were required by law to do, and they also had more things that they were not allowed to do, right? And so in this way, we were more carefully regulating them than we had before, despite the fact that we did have a piece of deregulation in terms of GrammLeach Bliley.
No, the regulation and crisis and regulation cycle has actually been going on in the United States for basically at least a century in the financial industry, right? And so what was the start of this regulatory movement? Yeah,
that's a great way to put it. I think really in order to understand the effects of GrammLeach Bliley and in order to understand the financial crisis, it helps a lot to look at the history of banking regulation in the United States. So really the type of regulation that we see now, I think, started with the founding of the Federal Reserve in 1913. And so we can think a little bit before the Federal Reserve. Prior to the Federal Reserve, we had money that was decentralized, and we had no single central bank that produced the money, right? That's what the Federal Reserve is. They're the central bank of the United States. They're in charge of producing the money for the entire country, and they're also in charge of regulating the banking industry, okay? But before that, banking was decentralized. All regulation, or let's say most regulation, was done at the state level, at least until the Civil War, and then it became more centralized after the Civil War. But we can look at the entire history prior to 1913 and see how well the banking industry did.
Right.
When we think in terms of money production, the price level over that entire period was basically stable. When the Fed was founded in 1913, prices were about the same as they had been in 1800. And so we can see that in terms of price level, things were pretty smooth. And several papers have looked at financial panics in that period, and it seems like it certainly wasn't any worse than we've had now under the Federal Reserve. But we did have, towards the end of that period, in the late 1800s and early 1900s, we did have a series of bank runs and financial panics, and that's something that really led to the creation of the Federal Reserve. Was that people said, well, look, we've got all these panics, we've got all these bank runs. What can we do to fix this problem, right? Looking back at that now, economists now realize that a lot of that problem was actually because of the restriction on interstate banking, that banks were only allowed to be in one state and not in many states, and that created a problem of panics at that time.
And how did that help make banks unstable?
So allowing interstate banking creates diversification. So we can have a situation where if there's a problem in New York and banks need money, they can take it out of their Chicago account and ship it to New York, and then they'll have the funds. Right?
Okay.
But if we have prohibition on interstate banking, then any one problem in New York, they can't get any more money, and one bank fails, and then another bank fails, and it causes a big panic. Right? That was particularly troubling in the 19th century because our economy was much more based on agriculture and certain things that were subject to shocks, where you might have a real bad problem in one area that didn't affect a wide area, but because we had these prohibitions on interstate banking, it made the system more fragile.
So the Federal Reserve comes into existence, and its first real test, I guess you could say, came a few years later, the Great Depression, 1929, the stock market crash, and it didn't do a very good job its first time out of the box.
They did not do a very good job, no. So rather than repeal the regulations on interstate banking, what we decided to do instead is we decided to patch it with a Band-Aid, that we would let one group, the Federal Reserve, control the money supply for the entire country. And we thought, well, maybe that'll be a better system. Maybe we'll have somebody in charge and they can manage the money supply in a way that'll work. But you're right, it didn't really work out that way. When we started to go into the Great Depression, the Federal Reserve made a big mistake because they thought there was too much money in the economy. So they ended up taking money out of the economy, which caused a lot of problems. People didn't have enough money to go out and spend, and they couldn't do the types of business activities that they wanted. And so everyone started holding on to their money, and it created a big problem of deflation and eventually depression. The Fed actually, it was actually worse than that, because once these banks started to fail, it was also the Fed's job to go in and bail them out, because the Fed is the central bank. Again, they were also in charge not only of the money supply, but of regulating the banks. And so when banks started to fail, the Fed should have bailed them out and didn't. And so that's what really caused the Great Depression to significantly deepen.
And so that the job of the Federal Reserve to bail out the banks was under this idea of being a lender of last resort, right?
A little bit of both, right? It was to coordinate the money supply, but also regulate the banking industry, be a lender of last resort.
And the idea being that the banks weren't really failing because they were bad banks or they had bad investments, but it was due to the panic, as opposed to just bailing out banks that had made bad investments or bad decisions.
It's a little bit of both. I mean, clearly some banks were failing because they had made bad decisions, but originally, the original job of the Fed as a lender of last resort was not to save banks that had failed on their own accord. Right? It was only to save banks that were insolvent because illiquid because of some kind of panic, not to save banks that were insolvent because they had made bad investments.
So we'd had this wave of bank runs and bank failures, which is exactly what the Federal Reserve had, in one sense, been designed to try to prevent. And so what did we turn to next?
So the Federal Reserve was unable to prevent the problem of runs and panics, and so we said, okay, we need a way to prevent bank runs, right? So what's the problem with a bank run? It's that everyone's afraid that the bank is going to go under. They run into the bank to take out their deposits. So the idea was, if we can prevent people from worrying about running to the bank to take out their deposits, we won't have bank runs. And so what we did was we created a system of deposit insurance. The FDIC, the Federal Deposit Insurance Corporation, was intended to insure deposits in banks so that even if your bank failed, you would still get your money from the federal government. And so if you're a depositor in a bank, you don't have to worry about the bank failing. You're still going to get your money. Therefore, you won't run on the bank if you're afraid it's going to fail. Okay, and so this was intended to prevent bank runs.
But at the same time, although you allay depositors' fears that they might not get their money back, it has an important effect on the banking system over time, right?
Yeah. Yeah, it's actually because we're taking away the depositor's fear of not getting repaid, then the depositor no longer has to worry about whether his bank is safe and solvent or not, right? So on one hand, you might think, well, that's a good thing. They don't have to worry about this. It makes it easier for the depositor. However, it also makes it easier for the banker. It makes it easier for the banker to take risk and do things that they wouldn't normally do if the depositors were watching the bank and taking care of it. So the FDIC deposit insurance, it did solve a little bit the problem of bank runs. However, it gave banks the incentive to take more risk. Okay, that's what we economists would call problem of moral hazard. That the bank, now that it knows that its depositors are insured, it's going to change its behavior and act in a way that we would think is kind of immoral, taking advantage of that insurance, right? So they know they're insured, so that means the bank is going to take more risk because they don't have to worry about their depositors.
And with depositors not worrying as much about what the bank's doing, it gives, in effect, the bank a little more leeway to get into trouble. It's not getting the signal from depositors trying to get out of the bank. Is like when they're starting to go down a bad path.
Yeah.
They're able to get much farther down a bad path.
That's true. Yeah, they are likely to take much more risk because they're not being as heavily monitored. Now they actually, so there is a distinction between, the banks will still have some incentive not to take risk because they're still being monitored by their equity holders. Right? People that own the bank, they don't want to lose their money, they don't want the bank to go out of business. Okay, but if we think about the distinction between debt and equity, right? Deposit holders are debt holders and owners of the bank are equity holders. Well, the deposit holders, they want the bank to be safe, right? The holders of liabilities don't want the bank to take too much risk because they have a defined amount that they're going to get. Whereas the equity holders, they're okay with the bank taking risk. They get the upside if the bank does well. They don't want it to take a ton of risk and only invest in super risky things, but they don't mind and they don't monitor it in the same way that the depositors do. And so it's not giving the bank an incentive to take purely huge giant risks, but more than they otherwise would if they were being monitored by depositors.
So this we patched the immediate problem of bank runs, but we did sort of create this moral hazard problem that was kind of building over the decades, right?
Yes, exactly.
And then that led to our next round of regulations that we want to focus on here. Almost 50 years later.
Yeah, so it's a while later. Through the late 30s and early 40s, it's kind of difficult to tell how much of an influence the banking industry had because of the end of the Great Depression and then World War II. But in the post-World War II era, we see that the banks at that time were heavily regulated up through the 1970s. In addition to creating FDIC deposit insurance, the Glass-Steagall Act of 1933 had also put a cap on the amount that banks were able to pay to their checking accounts, and so they couldn't pay a certain amount on their checking accounts. There was a limit on it, and so during the 60s and 70s, they did really weird things, like giving gifts away and things that were highly inefficient. So for example, if all the banks can only pay a certain rate of interest, normally, if you're thinking about which bank should I become a customer at, you would go to each different one and say, how much will you pay? How much will you pay? How much will you pay? In the 70s, banks couldn't do that. So they had these bizarre practices, like they would give away free toaster if you come join our bank.
Exactly.
We'll give you a TV if you'll come join our bank.
Remember getting
highly inefficient.
Getting a toaster to start a bank account.
Yeah, exactly. So that is not something that makes a lot of economic sense. And
so we did away with some of these regulations, but there was an important addition to what was going on here as well, right? To address this moral hazard problem. Yeah.
So in the early 1980s, in 1980 and then in 1982. In 1980, we had the DID-MCA, the Deposit Insurance Deregulation Monetary Control Act.
And that's a mouthful.
Yeah. So that's how some of these names are for these regulations. So the DID-MCA had a couple of different things that it did. One of the things was that it took saving institutions and credit unions under the Federal Reserve's regulatory power. Mm-hmm. Okay, so it gave the Fed a little bit more power there. It did deregulate some of the things that those entities were allowed to do. It took away the cap on what banks could pay in terms of checking accounts and interest rates, and then it instituted a regulation on capital, a requirement for capital for banks. So we were aware at that time, we wanted to deregulate a little bit because we knew the banking industry was inefficient, but we also were aware of the problem of moral hazard, right? We were aware that because of deposit insurance, some banks had an incentive to take too much risk. And so the idea was, what we'll do is, we'll say banks have to hold a certain amount of capital because we know that they're going to be taking a lot of risk, okay? when I'm saying hold capital, there's actually a distinction between reserve requirements, which is about assets, and capital requirements, which is about equity. Won't really bother very much with that now, but to say, let's just say the capital requirement was intended to make banks be safer.
Okay.
Okay. And then the other thing that happened, the Garn-St. Germain Act in 1982 allowed savings and loan institutions to invest in a lot of assets that they weren't able to invest in before.
And that, well, I guess it contributed to, or certainly preceded the savings and loan crisis then later in the 1980s.
Absolutely. One of the big contributing factors to the S&L crisis was the fact that we deregulated these S&Ls, because we had previously, throughout the 60s and 70s, they had been making loans at fixed rates, but because the Fed had created such high inflation during the 70s, all these banks were losing a lot of money. And so part of the impetus for those acts in 80 and 82 was we said, okay, look, a lot of these S&Ls are failing already. So we need to let them invest in things that are going to make a little bit more money so that they can potentially have the option of possibly recouping some of their losses, right? But again, we had just changed the regulation to say, okay, they've also got to hold some capital because we know they're going to invest in risky stuff.
Right. And so we had the whole savings and loan meltdown, the masses, some S&Ls got bailed out. This is the Keating Five at the time, very prominent, but showing also the influence of government policy making on the banking sector, right? And who got bailed out and who didn't.
Yeah, so the S&Ls, we gave them an incentive to take a lot of risk because we said, okay, well, you got to hold some capital, but now you can invest in whatever you want. And that's what they did, was they took a lot of risk. You know, the regulators were aware at that time that a bunch of those institutions were failing and gave them the incentive to buy a bunch of risky assets. And so what happened? A lot of them failed. Roughly half of the savings and loan institutions in the United States failed between 1985 and 1990. Like you said, you know, some banks got bailed out, but it was a bit of a political situation, as it is now, about who gets the money and who doesn't.
So I guess it was decided then that the capital requirements needed a little bit of tinkering, and that they hadn't worked out quite as anticipated.
Yeah, so once again, we have a situation where the capital requirements appear to have failed and actually caused banks to take more risk. Like a lot of consumer protections, they actually did the exact opposite of what they were intended to do. We were trying to make banks safer, and instead we end up making them take more risk. So rather than repeal those poor rules, we put another Band-Aid on them. That was, now we had a system where we're going to have capital requirements, but we're going to regulate what banks can invest in terms of the assets, whether they're risky or safe. So the next piece of legislation that is important comes after the savings and loan crisis of the late 80s to 1990. In 1991, we get the FDIC Improvement Act, which, as you said, was an attempt to improve upon these capital regulations. And so what we did was we said, okay, we're still going to make you hold capital, but rather than letting you invest in all kinds of risky stuff, we're going to regulate what you can invest in. So it's got to be some safe things and some risky things. And basically, the more risky things you invest in, the more capital you have to have.
And this is where you've done some research on these risk-based capital requirements, but unfortunately they end up being able to be gamed by the banks.
Yeah, so
often,
it turns out, in several studies have found that those regulations as well caused banks to take more risk. And part of the reason for this is regulators are just not good at knowing what assets are risky and what aren't. So the most famous example of this is that according to the risk-based capital regulations implemented in '91, mortgage-backed securities were one of the safest assets that you could buy. Obviously, looking back, we know that's crazy. It turns out they were one of the most risky assets that banks were holding that actually led to the financial crisis. Okay, so again, we gave banks an incentive to buy really risky assets, especially mortgage-backed securities, and that leads to the financial crisis of 2008.
And so we end up in the fall of 2008 with the financial system breaking down. But just again, as you mentioned, the hedge funds earlier, hedge funds were much less regulated, but they weren't really the ones in trouble in 2008, right?
No, and
it was the regulated part of our financial system.
And so ironically, even though, so this again gets back to our point about GrammL Bliley, where people were pointing to something and saying this is the problem when it actually had nothing to do with the crisis at all. People are again pointing to hedge funds and saying, well, these things are super risky, despite the fact that they were not the cause of the crisis. And so the Fed actually has now expanded to include regulating hedge funds as well. In the recent DoddFrank Act, that's one of the new regulations, is rather than stepping back and toning down the regulations, we're making more regulations. So now we have the Dodd-Frank Act, which is going to require further transparency. It's requiring a lot more reporting requirements, as we saw in the graph earlier, where they just shoot up. The number of regulations in banking shoots up in the last couple of years because of the Dodd-Frank Act.
No, the bailouts in the financial crisis creating this problem of too big to fail, I mean, it just adds to this moral hazard, right?
Yes, absolutely. So the too big to fail problem, again, the Federal Reserve, we would like them to act as a lender of last resort. However, they're intended to only bail out banks that are still solvent but illiquid, meaning the bank is fundamentally sound, they just don't happen to have money on them at the time,
right, rather
than banks that have made really risky investments and are failing. And so we would like banks to only bail out those safe banks that are just having a problem. But of course, that's not what they do. Right. They end up bailing out all the big banks that have taken a lot of risk.
And you had some important research recently exactly on this question of who got bailed out in 2008, or did the Federal Reserve follow the lender of last resort approach?
Yeah, that's exactly right. You know, we've brought in a lot of well-qualified, excellent scholars in the Johnson Center, and several of us now are working on money and banking regulation. And it happens that a paper of mine about Ben Bernanke's behavior in the recent financial crisis was just accepted to the Journal of Money, Credit, and Banking, which is the #1 journal in the field of money and banking. So a lot of good scholarship coming out of the Johnson Center. We actually just had an op-ed on that in Investors Business Daily over the last weekend. And so it's reaching top quality academic journals and also out into the popular press as well. And like you said, that was the same story of one of the main rules that the central bank is supposed to follow in financial crises is not to bail out banks that are failing on their own accord. And of course, that's exactly what Ben Bernanke did.
And then finally, we come to Dodd-Frank, which I guess the jury is still out on this to see exactly what's going to happen, other than that the reporting requirements are taking a toll. Yeah. But what are your prognostication here for Dodd-Frank, and whether this is going to solve the problem finally?
So it seems like every time we have a problem, it's caused by regulations, and rather than repeal those regulations, we just put another Band-Aid on it, and that's what I think Dodd-Frank is going to do as well. It's 2,000 plus pages, and I think it'll be nothing but problems.
Well, I guess we'll have to have you back on in a few years to give us an update on what's happening here with Dodd-Frank. Well, thank you very much, Thomas. We've come to the end of our time, but thank you for this, I think, very enlightening tour down the path of financial market regulation.
Absolutely. Thanks for having me.
And thank you for joining us this evening. Have a good evening, and join us again next time for another Econversations.